Imagine waking up one morning and realizing that gold, yes, the same gold your parents once bought as security, has crossed an unbelievable $4,000 per ounce. For centuries, gold has been called the metal of kings, a symbol of wealth and stability. But this time, it wasn't just shining. It was on fire. Just a day after touching that record high, the unthinkable happened. Gold prices fell back below the $4,000 mark as traders rushed to cash in their profits. What caused this sudden dip after such a historic milestone? And why did silver, its less glamorous cousin, suddenly break past the $50 barrier for the first time ever? This isn't just a story about metals. It's about power, fear, and the pulse of the global economy. From the Gaza ceasefire that cooled market tensions, to the US dollar's unexpected rise, to central banks playing their silent games, every factor is shaping a dramatic shift in how the world sees value. So let's dive deep into what really happened when gold touched $4,000 for the first time, and why this moment might just redefine the future of money itself. It started like a normal trading day, but within hours, the financial world stood still. Gold had just crossed the unthinkable $4,000 mark. For investors, it wasn't just a number. It was history being written. For months, tension across global markets had been rising. Wars, inflation, political instability, and a growing fear that traditional currencies were losing value. And in moments like these, investors always run toward one thing: gold. As prices began to surge, social media exploded. Traders couldn't believe what they were seeing, a record-breaking rally that no one had predicted would come this fast. Some called it a once-in-a-lifetime move. Others said, "This is just the beginning." But then came the shockwave. The very next day, gold fell back below $4,000. Many who had bought at the top saw their profits vanish in hours. Big players quietly sold their holdings while small investors held on, hoping the price would bounce back. The truth was clear. This wasn't just about metal. It was about fear, power, and timing. The people who understood that gold's value rises not because it shines, but because of the chaos around it, were the ones who won big. The golden shock reminded everyone of one brutal lesson. In the world of money, when everyone rushes in, the smart ones are already walking out. When gold first crossed the $4,000 mark and silver soared past $50, the world saw it as a sudden miracle. But nothing in the financial world happens suddenly. Every move, every spike, every crash, it's all connected to invisible forces working quietly behind the scenes. To understand why gold and silver exploded, we have to look at what was really happening beneath the surface. For years, central banks around the world had been printing money at record levels. Trillions of dollars flooded into the global economy, weakening the value of every paper note in circulation. Inflation didn't just rise, it quietly eroded the trust people had in their own currencies. And when people stop trusting money, they look for something that can't be printed, something real. That's when gold and silver become more than metals. They become symbols of safety. But there's more. Geopolitical chaos had reached a boiling point. The war in Gaza, political instability in Europe, and trade tensions between the US and China had turned global markets into minefields. Investors weren't searching for profit. They were searching for protection. And history has shown again and again. When the world burns, gold shines. Big institutions, hedge funds, and even central banks began moving their reserves from dollars to gold. Countries like China and Russia started stockpiling bullion, quietly reducing their dependence on the US dollar. It wasn't about beauty, it was about power. The more gold they held, the less control America had over them. Then came silver, the underdog no one expected. While gold grabbed the headlines, silver had quietly been building pressure for years. Industrial demand was skyrocketing. Electric cars, solar panels, and new tech all needed silver. At the same time, mining output was shrinking, creating a massive supply deficit. So when gold started its record-breaking run, silver followed, but faster, harder, and more aggressively. In just weeks, it climbed over $50 for the first time in history, shocking even veteran traders. The secret behind both rallies was psychology, fear and greed, the two invisible forces that drive every market. When fear dominates, people run to gold. When greed takes over, they chase silver for its explosive upside. This combination created the perfect storm. Even the Federal Reserve played its part. Their decision to cut interest rates fueled a belief that the era of cheap money was back. Every rate cut made holding cash less attractive and pushed investors deeper into assets like gold and silver. Meanwhile, social media magnified the frenzy. Viral videos, flashy charts, and influencers shouting "gold to the moon" pulled millions of new investors into the market, most of whom had no idea they were walking into a high-risk game controlled by the elite. But here's the truth. The rich didn't just invest in gold and silver. They designed this moment. They knew exactly when to buy, months before the crowd even noticed the trend. When retail investors rushed in, the rich quietly sold, locking in profits while the world celebrated their once-in-a-lifetime opportunity. This wasn't luck. It was strategy. The rise of gold and silver wasn't just about metals. It was a mirror, reflecting the world's fear, inequality, and manipulation. And as prices soared to the sky, one message echoed louder than ever before. In the modern economy, what looks like chaos to the poor is often a carefully planned opportunity for the rich. The world watched in disbelief. Just one day after gold broke every record in history, crossing the unthinkable $4,000 mark, it suddenly started to fall. Investors who had been celebrating just hours ago began to panic. What happened? How could something so strong collapse so fast? To understand that fall, you have to understand how the big players operate. Because in the world of finance, nothing crashes by accident. When gold hit its all-time high, it wasn't just small investors watching. It was the whales, the billion-dollar funds, and the central banks. They knew exactly what that number meant. $4,000 wasn't just a milestone, it was a signal that the world had finally gone all in. And that's when the game flipped. See, when retail investors, ordinary people, rush into a market driven by hype and headlines, they become the perfect exit point for the professionals. The same people who quietly bought gold months ago at $2,800 or $3,000 per ounce suddenly saw their chance. So while the public was buying, the insiders were selling. One after another, large institutions began unloading their gold holdings. Hedge funds booked billions in profit. The selling pressure started small, a few percentage points here and there, but in the digital age, panic spreads like wildfire. As soon as the charts turned red, algorithms kicked in. Automated trading bots triggered sell orders around the world. Within hours, gold had slipped below $4,000. And just like that, the dream turned into doubt. But there was another layer to this story, one most people missed. On the same day, the US dollar suddenly strengthened. After months of weakness, it jumped to a 2-month high. And because gold is priced in dollars, that made it instantly more expensive for foreign buyers. Demand cooled, and prices began to drop even faster. Behind the scenes, something else was unfolding. A fragile peace deal between Israel and Hamas. The world, which had been bracing for more chaos, suddenly took a breath of relief. And when fear fades, gold, the traditional safe haven, always loses some of its shine. Investors who had rushed to gold for protection began to pull back. They started taking profits, thinking, maybe the worst is over. But history has shown that's exactly when the real storm begins. Meanwhile, financial analysts filled TV screens, trying to explain the fall. Some blamed profit booking, others pointed to technical corrections. But behind those polished explanations was the same old truth. The rich had already taken what they wanted. They had fueled the panic on the way up and quietly cashed out before the crash. The media played its part perfectly, first hyping the rally, then amplifying the fall, keeping millions glued to the screens, reacting emotionally instead of thinking strategically. For everyday people, it looked like a mystery, but for those who understood the system, it was a script, one that had played out countless times before. First, build the hype. Second, let the crowd rush in. Third, sell when everyone else is buying. And finally, watch as the market collapses, only to buy again when prices are low. By the time gold slipped below $3,990, the cycle was already complete. The small investors were left holding the bag, wondering how something so safe could fall so fast. But the truth was never about safety. It was about timing, and the fact that in modern finance, emotion is the most expensive currency of all. So while millions lost sleep watching gold fall, the insiders slept peacefully. Because for them, the fall wasn't a disaster. It was payday. While the world's attention was glued to gold, something incredible was quietly happening in silver. For years, silver had been the forgotten metal, the little brother of gold. Investors rarely talked about it. It was cheaper, slower, less glamorous. But in 2025, that changed completely. When gold hit its record high, silver suddenly began to rise with unstoppable force. And for the first time in history, it broke through the $50 per ounce barrier. Now, that number isn't just a statistic, it's a symbol. Because silver hasn't seen that level since 2011, when the world was still recovering from the financial crisis. Back then, silver's rise was fueled by panic. But this time, it was something much deeper, a perfect storm of global economics, supply shortages, and human psychology. Let's break it down. The first reason behind silver's comeback was pure momentum. As gold started skyrocketing, millions of small investors began searching for the next big thing. They couldn't afford gold at $4,000, so they turned to its more affordable cousin, silver. That sudden wave of demand hit an already tight market. Because here's the thing most people don't know. Silver isn't just a precious metal, it's also an industrial metal. It's used in solar panels, electric vehicles, and electronics. Industries that are booming in today's world. So while investors were buying silver as a store of value, manufacturers were also scrambling to get it for production. Demand doubled, but supply didn't. Silver mining has been struggling for years. Costs are high, new discoveries are rare, and refining takes time. So, as more people rushed in, prices exploded like a rocket. But there's another layer, the emotional one. Silver carries a kind of underdog energy. When people see gold dominating headlines, they feel like they've already missed the train. Silver gives them hope, a second chance to get in early. That psychology alone drives markets higher than logic ever could. By the time silver crossed $50, news outlets called it a historic moment. Analysts spoke about catch-up potential, predicting that silver could soon follow gold's path. Social media buzzed with excitement. Memes compared silver to the comeback kid of the financial world. But deep down, professionals knew what was happening. Silver wasn't just catching up to gold, it was proving something. It was proving that faith in real assets, tangible, hold-in-your-hand metals, was stronger than ever in a digital world full of uncertainty. And while gold's story was about power and safety, silver's story was about rebellion. It was about small investors challenging the system, betting on something real, and reminding the financial elite that value doesn't always come with a high price tag. For a brief moment, silver wasn't the shadow of gold. It stood in its own light, shining brighter than ever before. Whenever gold or silver prices start to move, there's one silent force standing behind the curtain, the Federal Reserve. It's the invisible hand that controls the heartbeat of the metal market. Most people think gold prices rise just because of demand or inflation, but in truth, it's deeply tied to one thing: interest rates. And that's where the Fed comes in. When the Federal Reserve cuts interest rates, borrowing becomes cheaper. Businesses expand, consumers spend more, and the economy looks stronger, at least on the surface. But here's the twist. Every time rates drop, the value of the dollar weakens. And when the dollar weakens, gold and silver shine brighter. That's exactly what happened in 2025. The Fed had already lowered rates by 25 basis points in September, and traders were betting on more cuts in October and December. These rate cuts were meant to protect jobs and prevent the economy from slowing down. But they had an unintended side effect. They poured fuel on the fire of the metals rally. See, gold and silver don't pay interest. They just sit there. No dividends, no yields. So when bank interest rates are high, investors prefer cash or bonds. But when the Fed slashes rates close to zero, holding cash suddenly feels like a losing game. That's when people rush toward metals, real solid assets that don't lose value when paper money does. The Federal Reserve's every move, every statement, every word in their meeting minutes becomes a signal to traders. One hint about possible future cuts can send gold soaring overnight. And when the Fed sounds cautious about inflation, silver spikes too, because both metals are seen as protection against economic uncertainty. In September's meeting minutes, Fed officials openly admitted that the U.S. job market was fragile and inflation remained stubborn. That confession was enough for investors to read between the lines. More cuts are coming. Within hours, the metals market reacted like a living organism. Prices jumped, then dipped, then jumped again. It wasn't chaos, it was choreography. Every trader, every investor, every central bank was dancing to the rhythm of the Federal Reserve. But beneath all the noise, a deeper question began to rise. How long can this game last? Each time the Fed cuts rates to stabilize the economy, it also pushes people further away from trusting the dollar. And the more people lose faith in currency, the stronger gold and silver become. It's a paradox. The same institution trying to save the economy may also be the one fueling the next big metals boom. So while headlines celebrate the rate cuts as economic rescue plans, those who understand the deeper mechanics see it differently. They know that every time the Fed lowers rates, it quietly raises the value of fear. And fear is what makes gold and silver priceless. When gold breaks records and silver surges past milestones, it's easy to think these stories belong only to Wall Street, traders, billionaires, and financial analysts. But in truth, the shockwaves hit every American household. Because behind every metal rally, there's a story about trust, power, and survival. When the price of gold climbs above $4,000, it's not just a number, it's a signal. It means people no longer feel safe keeping their wealth in dollars. It means fear is growing and faith in paper money is fading, and that fear always finds its way into real life. The average American family, already struggling with rent, groceries, and rising interest rates, starts feeling the pinch. When gold prices rise, it's often because inflation is getting worse. Everyday items, from gas to food to housing, quietly become more expensive. Meanwhile, those who already have assets, the rich, benefit from this shift. Their investments grow in value. Their gold, silver, and stocks act like shields against inflation. But for the middle class, it's the opposite. Their savings lose value. Their dollars buy less. And they're left wondering why the harder they work, the smaller their paycheck feels. That's the real story behind this gold and silver boom. It's not about metals. It's about a widening gap between those who know how the system works and those who don't. Every time the Fed cuts rates, every time global uncertainty rises, those who understand money make moves. They shift assets, hedge bets, and protect wealth. But ordinary people? They just see prices going up and salaries staying the same. The bigger picture is clear. Gold's rise isn't just about profit, it's about warning. It's a reflection of a world losing balance, a world where economic safety is no longer guaranteed. So what can the average American do? They can start by understanding why these moves happen, why gold rises when the dollar falls, why silver becomes more valuable when technology booms, why central bank decisions affect the price of everything, from your coffee to your car loan. Because once you understand the system, you can stop being a victim of it. History has shown that those who pay attention to global shifts, not just headlines, are the ones who survive financial storms. You don't need to be rich to play smart. You just need to be informed. So next time you see gold flashing across your screen, don't scroll past. Ask yourself what it really means for your money, your future, and your family. And if you want to keep learning how global finance quietly shapes your life, hit that subscribe button. Because here, we don't just talk about money, we uncover the hidden truth behind it.